I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. This week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion.
Tomlik kicks off with a data-backed analysis of what's known as a waterfall decline, a sudden market drop of over 10% in just 2 weeks. His research highlights 12 similar events in recent history, and in nearly every case as long as there was no recession, market staged a strong V-shaped recovery. In light of the latest tariff-induced sell-off, Lee makes a bold call: expect a fast and powerful rebound. The history supports it. The data backs it. And before that, be the one who says I was here before 100K. I'm on a mission to hit 100K subscriber before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comment. Let's win and grow together.
As the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall, but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And of course, everyone argued against it for logical reasons. They said, tariffs, they're not going to be solved for a year, The Fed's not your friend. The Fed is there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion. I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the 6 figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for 2 reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset, and companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. But banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stable coin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market, and it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's
But how
not
do you
public.
trust those Tether people? Like, you don't really know what's going on.
Well, that's
behind the
where.
scenes.
See, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code.
Mm-hmm.
And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world.
Wow.
So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you, again, model this out and utility, because remember, stable coins is only a $250 billion market today. So you realize that stable coins collectively are the 12th largest holder of U.S. treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
He highlights a surprising truth about the global financial system. Even within a single bank like JP Morgan, moving money from its Japan branch to its U.S. branch isn't seamless. Due to compliance regulations like OFAC and FinCEN, the transaction must pass through external intermediaries, adding friction, cost, and delay. This example exposes how outdated and fragmented the traditional financial infrastructure really is, and why blockchain-based solutions like stablecoins offer a vastly superior alternative: instant, borderless, and programmable.
Let's say do approximate percentages.
Okay.
So let's just say that there's two ways to value markets. One is the underlying earnings, and the second is the expectations of either how good the existing numbers are or how much they can grow. So in other words, that's all the narrative part is essentially valuation. And to me, the adage in the stock market historically has been it takes a whole lot of E to offset PE. Meaning that earnings can move 5% or 10% versus what you thought, but the reason the stock might go up 50% is more because of narrative. So I think that in like a very simplistic sense, narrative drives stocks more than earnings do over the intermediate term. We can see it in stocks that essentially have turned shareholders into customers, like stocks like Tesla or Palantir defy people's fundamental understanding of earnings because the valuation of the stock relative to its earnings seems far greater than someone can explain, but that's because these have really compelling narratives.
Right. And so with earnings, we're talking about profits.
Yeah. And Alex, I might be forking here, but
Fork away.
I believe Tesla and Palantir and stocks like HIMS are proof that money is not how you measure the value of a stock. Because if money is determined as the earnings per share, the value of a company isn't just the amount of money that it represents. It really represents a customer's trust in the actual business model.
Okay.
And so that's where PEs can actually be much higher, even for a level set of earnings. Like, let's say that a lot of your viewers are bearish, and they're bearish and they've been trying to expect the stock market to go down, or maybe they sold stocks in April. And then they're like, well, the only reason markets are going up is AI, and I think they're already overvalued. They're missing that there's a lot more to sort of the narrative of the S&P that explains why stocks are doing well. So that's why AI is important, but it's not the only story in the stock market. By the way, most people may not realize this, but money has to move through a supply chain.
Talk more about that.
Well, let's say that you're a bank in Asia and then you want to move money to the United States. You have to move it through an intermediary. And then from there, it gets moved to another intermediary. So there's a supply chain. In fact, if you're a global bank, so take Barclays or JP Morgan, and you have money in, let's say, Japan, and you want to move it to the US, you have to use an external intermediary to move the money. Banks can't internally transfer the money because it violates OFAC or FinCEN. If a bank has money in Chicago, a branch in Chicago, and they want to move it to Texas, they have to move it externally through the supply chain back into the bank. Otherwise, so like you'd think, oh, they just do an internal transfer because it's all accounting and money is like imaginary in a sense anyways. It's just digital, but they can't. They actually have to move it externally first.
Tom Lee's perspective cuts through the noise with clarity and optimism. He challenges the mainstream doom narrative with a mix of historical context, data-driven analysis, and forward-looking conviction, from the overhyped fear of Fed policy to the overlooked strength of high-yield markets and the unstoppable rise of Bitcoin and stablecoins. Lee sees a world not in decline, but in transition. Innovation, he argues, is winning. *, the full story continues here. Watch now.